This is System Trader Show, episode number 6.
Welcome to System Trader Podcast. Listen to interviews with top traders and find out how the most successful traders beat the markets and what are the secrets of their success. This is System Trader Podcast with your host, Jack Lempart.
Davey is a full-time professional algorithmic trader specializing mostly in futures. Using his trading systems, he generated annual returns of 148%, 107%, and 112% in 3 consecutive World Cup of Futures Trading Championships. Today we discuss various trading topics, including the reliable trading system development process, so that developed systems may look good not only on the past data. I encourage you to visit my website at systemtrader.show/006, where you can find more materials related to this episode. Enjoy the show. Hello, Kevin, and thank you very much for being here today. I'm really glad that you want to share your knowledge and experience with us. Could you please tell us a bit about yourself?
Sure. First of all, I just want to say thanks for having me, and I know you've had a lot of really good traders who've also done interviews with you, so I'm kind of honored that you'd pick me. But, I've been trading for over 25 years. Not all of it was full-time. The last 10 years, I've been doing it full-time. I was able to make that leap from part-time kind of hobby trader to a full-time trader. And that's really where my passion lies. My background was in engineering, and I got a master's in business, but what I always loved was the markets and the challenge of the markets. And so trading was kind of a natural progression for me. And so I trade full time. I live in the U.S. in Cleveland, outside of Cleveland, Ohio, and I'm able to work from home, which is great. And, the kids love it, although sometimes they get in the way of trading. But, I'm able to trade full time, and I'm also able to do some teaching for some people who want to learn how to improve their trading.
Okay, thank you, Kevin, for that. And so, how long it took you to become a profitable trader?
That's a good question. I always look back on it, and I might be a little bit off, but I know about the first 10 years, at least, I had a lot of trouble. So I might have had profit some of those years, but a lot of those years were also losses because I was just doing a lot of things incorrectly. I was skipping from method to method and all kinds of things. But probably in the early 2000s or so, I started to get a better feel for what I should be doing and, how not to back test and those kind of things. And that led to 2005, 6, and 7, where I was able to do pretty well in a trading contest. And that was probably the turning point, because that was right around the time, too, I became full-time. So I would probably say the first at least 5 years, probably the first 10 years, I was still making some big mistakes that were costing me money.
Okay, thank you, Kevin. I will get back in a second to the World Cup Championship of Futures Trading Triumph, but in the meantime, I just wanted to add that I just was reading recently your book, and I found saying that trading full-time is, you said, the toughest way to make easy money. So I really like this statement. It says a lot. What were your biggest mistakes you made on your way to professional trading? You already mentioned that there were some problems with backtesting, but if you could go a bit more in details, if you can recall what was the biggest mistake you made on your way to become a profitable trader?
Probably the biggest mistake overall I made was not understanding how difficult it is to trade. I was assuming no matter what method I used, whether it was a discretionary method or something I was able to backtest or something that couldn't be backtested, and I still wanted to trade it. No matter what method I tried, I always assumed I would make money. And that's definitely not the case. And when you also add in the risk involved, yes, you might make money, but in the short run, you're almost always in drawdown. You're always losing money at some point. That was the hardest thing for me to grasp that I didn't get right off the bat. I mean, I thought I'd start trading and start making some consistent money and just keep going. And I didn't really have appreciation for things like risk of ruin, where even if you had a winning system, if you are not well capitalized or you can't handle the drawdowns, you might quit a winning system just because of normal drawdowns, and you never get to that end profit. You get wiped out early. And so I had a lot of that where I was just trying to get by on small accounts and trying to do too much. So I would probably say overall, yes, I had back test problems and all that kind of thing, but just not appreciating the risk and being kind of undercapitalized for what I was doing were probably the biggest kind of mistakes that I made.
Okay, and I think it's pretty typical among other traders as well. As far as I remember, you became a full-time trader in 2008. And looking now on the time behind, are you happy that you decided then to go for being a full-time trader rather than working as an employee and having a monthly salary?
Well, yeah, that's obviously something. Looking back on it, I was like, wow, that was a big leap. As it turned out for me personally, just with my work, I had an opportunity to leave and have some money and have enough money saved up. So it worked out real well. The freedom to work out of your house and, to always be around where I can do stuff for my kids' schools and do that is great. It also comes with a lot of responsibility because it's so easy to not work. It's so easy just to sit back and oh, hey, I got to do this kind of back test or something, but I'll just do it tomorrow. So it working full time on your own is really kind of tough because you really have to be self-motivated. And a lot of people, I think, need the motivation that a full-time job gives. The other part you just mentioned was the full-time pay.
Right.
That is really hard and to give up. So I was lucky because my spouse, we sat down before and I said, hey, this is my dream to full-time trade. I think I can do it. What do you think? And she was all for it. But if she hadn't been, if she said, no, you really can't give up your job, the money's too good, that kind of thing, I probably wouldn't have done it because, if the support's not there, I think we're in real trouble. So, looking back on it, it was really a leap, and I'm glad I took it, but I definitely did not do it the best way. I wish I had started with more money in my trading account and that kind of thing. But, those kind of things I think you learn as you kind of go through it.
Right. So you mentioned a pretty important thing. I think that you need to have kind of support in your members of your family. Like you said, your spouse fully supported you. And I think that this is maybe a very important factor which makes you more confident in your trading, which is very, very important.
Yeah, it's huge to have support of people around you. I always tell people, my wife and I used to have it was almost a little game when I first started full-time trading, because she'd come home from work and she'd ask me if I made money. And a lot of times she could just tell by looking at me if I made money. And the nice thing about that was it didn't really bother her if I didn't. She was, I'm sure, disappointed that, oh man, you lost money again. But she didn't hold it against me and say, you got to start making money, that kind of thing, which is huge. And, anyone who out there who's thinking of full-time trading or even part-time trading, honestly, if you don't have the support in your immediate family, it's going to be tough, because trading is not this smooth kind of, hey, I make money every day kind of thing. It's up and down. And if your emotions show that, you're going to show that to your family. You're going to be mad some days and they're not going to know why, and you're going to have mood swings, and that's all going to affect them. So if they're not fully tuned to what you're doing, it's going to be trouble.
Okay. Thank you, Kevin, for that. You have recently published your new book titled Introduction to Algo Trading, How Retail Traders Can Successfully Compete with Professional Traders. And the title suggests that being a retail trader doesn't mean that professional institution cannot be beaten. In fact, I see as an important thing that, after all, what's the reason to spend private time trying to make some profit if I just could put my money to be managed by some professionals? In other words, if I decide to trade and I dedicate my private time to trading, I need to have some, let's say, premium for it, which pays for the effort. How do you see this?
I agree. If you're going to spend the time to do it, you really need to have a reasonable chance at getting that reward. And the pros out there are the people you're fighting against. A lot of people say, hey, no, we're all in this together. But honestly, especially with futures, for every dollar in a specific market that I make, somebody else is losing $1. And yeah, they might be hedged somewhere else, and so maybe that doesn't matter to them. But in the end, everybody's trying to grasp money from this finite pool. There's not this unlimited pool of money. And so that's who you're up against. And if you don't put yourself in a position where you think you can beat them, then it's definitely better just to go the passive route and just put money with one of these pros. That being said, you're going to pay fees and all kinds of extras for that privilege, because obviously they want to make money too off of their advice and their knowledge. So, yes, I do think retail traders can survive against the professional traders, but I think what's important is that you don't play their game. So, and what I mean by that is, for example, there's a lot of high frequency trading firms out there who buy and sell in split seconds, milliseconds or even lower. And there's no way you as a retail trader can trade that fast or have the infrastructure built up to allow that kind of trading. So if you're trying to play that game against them, you're probably going to lose. So where I think you can compete is doing some longer term trading. And that's what I primarily do, where it's more what I would call swing trading, where trades will last days to even weeks sometimes, where you try to hop on those longer trends. Now, of course, there's definitely professionals who will fight there and fight you in that regime, but I think your chances of success go up there. So, in the end, the way I see it, it's definitely possible to make money and to make it worth your time, but it's also very difficult, and there's no guarantees. It's, if you're going to be a doctor, for example, if you spend the time, you go through medical school, you pass all the medical tests, you do your residency, and in the end, there's an expectation you'll be a doctor and you can go earn a living. But with trading, you could spend years studying and practicing, and in the end, there's no guarantee that you're going to be able to be a successful trader. And that's kind of hard. You're doing things for an uncertain future, but that's kind of why I wrote that intro book, to kind of give people some exposure to what algo trading is all about, but also kind of point out some of the pitfalls and some of the dangers in trying to go this route, because it's far from something that everybody can do.
Okay. By the way, your latest book, Introduction to Algo Trading, is really very good source of information, especially for someone who's, I think, starting from, let's say, zero level. I mean, having no knowledge at all. And I think this is a very good starting point for someone like this. But also, I read it after like 10 years being on the market, and I still found it very interesting to me. So very highly recommended book. So you say that as trading is very, very hard, but on the other side, do you think that being a retail trader give us some advantage? For example, having a smaller capital, we can, for example, it's easier for us, for example, to take a position, to close the position.
Yeah. So there's a couple things with being smaller. One is, you're not going to have huge positions open, which you need to close slowly over time. Two, you can trade some of the smaller markets. You might be able to find a good strategy in, say, orange juice, which, big professionals, they don't trade that a lot because there's not a lot of volume with it. So you can do some of those. The other thing, too, is you might have different risk tolerances. You might be able to risk a little bit more than a professional, either hedge fund or commodity trading advisor. And, the other thing too is those guys, those professionals, once they get money under management, their focus isn't necessarily getting great returns. Their focus a lot of the time is not losing those funds. They build up their fund. They don't want people to abandon them because they had a bad drawdown. So what they will do is they'll tend to take smaller risks to keep their fund assets higher. And so that's where, as a small trader, you don't really have to worry about that kind of thing. So, there's definitely areas where a small trader can kind of outmaneuver the big guys.
Okay, so that's some positive accent, let's say, on the way of becoming a retail trader. Kevin, you have participated in the World Cup Championship of Futures Trading Triumph 3 times. Could you please tell us how it happened that you decided to participate in the competition?
Okay. Probably I believe it was in 2004 or 5. No, actually it was 2003 or 4. I'm sorry about that. I started to get better with my trading and started to develop more what they'd call algos today, but back then it was called like systematic trading, but basically rule-based trading. And I started to feel a little more comfortable with what I was doing, and I was doing pretty good. And I thought, well, how do I really see if I'm doing good? And I saw about the World Cup contest, and I thought, well, hey, if I can do good in this, that would be a pretty good indication that I can actually trade decently. So what I did was I believe 2003, I was kind of thinking about it. In 2004, I was thinking about it a little bit more. And as it turned out, I didn't enter in 2004. But if I had done it and followed the systems, I actually would have. I'm not sure if I would have won, but I know I would have finished either in first or second. Of course, I didn't enter. But that just gave me more incentive to say, I got to enter. But what I did was I went back and looked at the contest and looked at all the previous winners. And at the time, I was able to access like the top 3 finishers every year for the past number of years. I don't think that information's on the website now for the World Cup, but I was able to get that info. I don't even think it was on the internet back then. But I took a look at the top 3 finishers for, say, the past 10 years. And after analyzing it, I basically came to the conclusion that if I got 100% return in a year, I should finish around the top three, somewhere in the top three. And that was really one of my goals. My other goal was to beat a trader. His name was Kurt, who I'm now friends with, but he was always kind of my idol of somebody that was a great trader who I thought, wow, if I could beat him. So that was kind of a secondary goal. So what I did was I just designed my strategy around doubling my account. And I said, well, if things go right, I'll double my account and I should finish in the top three. And, that was the way I approached it. And I didn't say, oh, I'm definitely going to do it, because there's always, in a trading contest or any kind of trading, there's always some luck involved with where you really end up. You could end up having a little bit of bad luck and things don't work out, but you could also have good luck and things could go out a lot better than you think. So, aiming for that 100% was kind of my goal. And as it turned out, the next 3 years, 2005, 6, and 7, I was able to do that each of those years. So that was the biggest takeaway, because people always say, well, hey, it's a contest, and is that really realistic? I said, well, not really in the aspect of being risk averse. In your normal trading, you don't want to necessarily go for great returns because that usually means you risk more. But for these the contest, the goal was the highest return. So that's why basically I created my strategy and money management and position sizing, everything else to meet that goal. And that's the big takeaway for me, is I had a goal, then I designed strategies to meet that goal. I implemented it, and it worked out. And that was the big lesson that I learned, because then going forward in my own trading, especially when I went full-time, the goal wasn't 100% return. It was a certain risk-adjusted return. That's what you got to hit. And so that's, I would design strategies and position sizing around that goal. And that's the big thing, at least what I got out of the contest.
What kind of methods did you use during the competition? I mean, was it much different to what you're doing currently?
It was basically the same. So I had an idea, and what I did for those contest years was I actually had the same system, same basic strategy with different parameters for, I believe, 8 or so different markets. And it was basically a trend following approach. But I analyzed it, tested it. I did walk forward analysis, which is a method I use to get out of sample data. And I said, well, if I trade this portfolio, I should be okay. And there really weren't that many trades, because I think I only started, it was either a $10,000 account or a $15,000. I don't quite remember at this point.
15K.
But yeah, it's a pretty small account relatively, especially to be trading eight different markets. But as it turned out, I was able to do that. Now, compared to what I do today, I look more for market-specific strategies. Although, if I find a strategy that works, say, for the euro, I'll definitely try to apply that same basic strategy to other markets and see if it works. But back when I was doing the contest, it was more, here I have one core strategy and I'm going to apply it to 8 different markets. And I don't do as much of that anymore, only because it's hard to find strategies that work across a whole bunch of markets. I know a lot of people out there, probably a lot of your listeners say, well, hey, I have to have a strategy that works on 3 different markets or 5 different markets. And my experience is that some of those are out there, and I do have some of those, but for the most part, each market's unique enough that what works maybe in the euro might not work at all in, say, the British pound, which, is sort of similar. You just don't know, but you have to evaluate it and see, and sometimes you do get those.
Okay, I understand. On the other hand, do you think that the fact that you used just a single strategy on multiple markets, that it maybe helped you to be less overfitted, let's say?
Yes. That's part of it. Although for each system, I still had a certain number of parameters that were tailored to that particular market.
Okay.
So there was still some fitting. It just wasn't a ton. But yeah, that's a good point. Is what you don't want is a strategy that's so specific and so detailed just for that market, because you might just be measuring noise on a particular market, and
right.
You don't want to build a system that's just reacts to noise.
Kevin, why did you decide to be a systematic trader rather than discretionary then?
For me, my background was engineering, so I always liked numbers. I liked computer programming, and those kind of skills, the number skills, the programming skills, tailor well with a systematic, algo, rule-based type, whatever you want to call it, approach, where you define things and you test it, and yes, okay, it looks good, and then you just follow the rules. That's probably the main reason. So my background and my skills kind of fit that. And the other thing I noticed, I have done discretionary trading over the years, and what I noticed with discretionary trading, it's just, for me, discretionary trading is very difficult to be successful, because I overrule, and I sometimes make some rash decisions and that kind of thing. And what I found was the rule-based type systems were great for me psychologically, so they just fit me. Dr. Van Tharp, who was a market wizard, trading psychologist, he helps a lot of traders. His big thing is, hey, you got to find a system that fits you. And that's absolutely true. And if you can't, so there's people out there, for example, who have trading rules and say, I'm going to program my strategy and follow it, and then it turns out they can't follow it, and they overrule their system and turn it off. Those are not people who should be trading systematically. Maybe they'd be better off discretionary. So you really got to find, for your particular personality, what really works for you. And for me, it was definitely rule-based, kind of methodical, analytical type systems. That's what worked best for me.
Okay. Are you still maybe tempted from time to time to take some transaction, let's say, in a discretionary way?
No, actually, I'm not. But at the same time, I'm always looking for new approaches, different approaches than what I do now. So what I do now is, all these algo type systems, and most of them are just running automatically. But at the same time, if I would find a discretionary method that looks good, and maybe I play around with it a little bit and determine, hey, this is something I can really use and succeed with, I definitely would be open to it. Again, it might be kind of hard for me to do, but right now I don't do any type of discretionary trading.
Okay, thank you, Kevin. So regarding your trading, which markets and timeframes do you trade?
Well, I trade basically all the U.S. futures markets. So anything on the the CME exchange, the Chicago Mercantile, which includes grains, metals, energies, all that, stock indices. I also trade the ICE exchange in the U.S., which is more of the kind of soft markets, cocoa, cotton, coffee, those kind of things. So I limit myself to the U.S. markets, but anything with sufficient volume, I look to trade. Whether it's, like I said, whether it's cocoa, whether it's corn, it could be the stock indices, and I kind of put them into 6 sectors. There's interest rates that are like the 30-year bond, the 10-year note, those kind of things. The stock indices, energies, metals, currencies, and then agricultural / softs. A lot of people break it up into meats, grains, and all those other markets. I tend to lump them together as a group. And so what I try to do is try to keep balance among those groups. So I try to look at, well, hey, I have a whole 10 energy strategies, so I've really got to work on getting 10 currency strategies. That's kind of the way I look at it. And as far as time frames go, I usually like swing trading. I'd love to do all intraday trading where, you go home at the end of the day and you're flat and you have no exposure. But what I've found is a lot of markets will actually more or less pay a premium if you hold overnight and hold over weekends. So even though some of that, there's some risk involved, it usually turns out to be profitable to do that kind of thing. So that's kind of where my time frame is. Now I do have some intraday systems that get in and out maybe in a half hour, but a lot of them tend to last a little bit longer.
Okay, that's very interesting. Thank you for that, Kevin. By the way, so you said to not underestimate the daily bars, for example, that there still we can, on top of them, we can build good systems.
Yeah, daily bars are nice for a couple different reasons. One, if you were to look at 1 minute or 5 minute data, there's usually a lot of noise, it up and down without real trends in that, where the daily bars tend to have more trends. Now, obviously, there's definitely still noise with that, but it tends to be a little bit easier to find trends with daily data. And the other big thing with daily data, depending on how your data provider gives you the data, the closing price is usually the settlement price. So it's the price at the end of the day that the exchange tells everybody that figure out your profit and loss based on this price. And that tends to have a little more weight than the daily, the minute bar close at 10:22 a.m. doesn't really mean much, any price during the day, but a closing price at the end of the day, that's what people are calculating margin based off of and how much they need in their account and what their current equity is. So there's a little bit more information with the daily bars that you might not get with those intraday type bars.
Okay, thanks for that. Kevin, would you be able to say how your style, trading style, or the process of building a robust trading strategies differs to other champions traders like Tim Ria, Michael Krug, or Andrea Unger, which I know that you know. So, but I know that basically there's plenty of ways how to achieve success on the market. But I know that your style is a bit different.
Yes. And all those guys, Tim, Andrea, and Michael, I all know because we've actually taught a class together in New York for a couple of years. A couple of years ago, we did that. And it's neat because I learn a lot just from them. And Yes, they do things the same, but they also do things differently. So for Michael, for example, he used to work for a hedge fund. So, he's got that kind of background. So he tends to approach systems trading a little bit differently. He's not the pure kind of algo type person because he's just, over the years, was trained to think differently. And so he does more things with the options, for example. Tim and Andrea are more like what I do, just in the respect of building algos and testing them and then implementing them. Where those two guys differ is just the approach. I use walk-forward testing, which is a way to get out-of-sample results. Tim and Andrea don't. They do, but they do some other things that I don't necessarily do. And so you're right. There is no really one perfect way to do it. But going back to what I talked about earlier, what is important is that you feel comfortable with what you're doing and that you can implement it. And, when you feel confident, it's much easier to trade, especially when drawdowns happen, because drawdowns always happen. But having that confidence helps you push through them. But so for most people out there testing systems, it's the big problem is it's easy to test the wrong way and to overfit systems and to use too many parameters and that kind of thing. And when I look at what Tim and Andrea do, I know that they are not doing that kind of thing. So even though they're doing things differently than I'd normally do them, they can succeed because they're still doing things for the correctly. At least I don't want to say correctly because obviously they're having success. They just do things differently than I do, but it works. And that's the ultimate judge. There's people out there who say, I'm not going to back test at all because that's just historical data. Well, that's something I would never do. I would never consider that correct. But if what they're doing leads to profit, then who am I to say what they're doing it isn't a good way to do it? It becomes a personal decision, I guess, of how you're going to implement it. But at the end of the day, you got to have that feedback of, yes, I'm doing things different than anybody else I've ever seen, but I'm making money, so therefore I feel comfortable with it. And that's kind of the way I look at their trading. But I've definitely picked up some things from just watching how they develop systems and how they do things. And I've incorporated some of that in what I do. And it's funny, we've also had lively discussions of, hey, I don't think you're doing this right. And they say, well, I don't think you're doing this right. And we kind of, a friendly argument of the pros and cons. But in the end, I think it makes all of us better seeing how people do things differently.
Okay, that's very interesting, Kevin. Do you have any traders which influenced your way of trading mostly, or maybe did you have any mentor, or maybe you still have someone who's inspiring you?
Probably the biggest mentor, which I don't even know if you could really call him that because I've never met him. I've never attended any of his live classes. Was Van Tharp. I'd read a bunch of his books. I got a couple of his home study courses, and he kind of put me on the road of like the system trading kind of thing. And that's probably the closest to any kind of mentor that I've had. But really, a lot of it was just self-taught, and a lot of it was going down the wrong road. I'd see a new trading book and I'd buy it about some exotic method or something, and I'd read it, and sometimes I'd go and try it. Other times I'd be like, well, this is ridiculous. How did this person write a book? Kind of thing. Because there is a lot of garbage out there, and there's a lot of misleading stuff out there. But I tell this to a lot of new traders. If you don't really know where to go, just read a bunch of books and trading books, and you don't even necessarily have to buy them. You can, if you have a good local library, you can get a lot of them for free. And what I tell people is don't judge what's in the book, just read it. And after you read a whole bunch of trading books, you eventually get a good feel for what's real, what's not real, because a lot of the hype and a lot of the phoniness becomes apparent. It doesn't become apparent when you read that first book because you're going to believe everything's true, but you'll believe it after a little while after you read enough books. And then you can kind of go down a path of saying, okay, well, this kind of makes sense. It seems reasonable. I'm gonna go down this road, and that's a good way to use books. And it's certainly kind of the way I did it, instead of having just one mentor.
Okay, thank you for that, Kevin. Is your trading fully automated currently? I mean, you just run all these trading systems on the machine in an automatic fashion?
Most of my systems, yes. So probably right now I'm running, I think, about somewhere between 70 and 80 strategies.
Wow.
And most of those are running automated. So whenever they want to place buy and sell orders, they will do it. So earlier, a couple minutes ago in the interview, there were some orders that hit. And so through my headphone while I'm talking to you, I hear order filled. And that's just what happens. So for those, just a few times a day, I look at all the positions and add them up and make sure that what my account says matches what these systems are saying I should be. And if there's a discrepancy, I have to correct it. So in that respect, it's not fully automatic. I do have to go in sometimes and make adjustments. The other part where I wish it was automated, but it's not, is when you do rollovers with swing trading systems. So for example, like the energies, every month you have to roll your position. So if you're in a long, like right now I'm long November crude oil, but in a couple weeks, or I don't even know when, and the computer will tell me when, I have to roll into December. So I'll have to manually exit my November position and then open my December position and update my charts and that kind of thing. So I'd love to say it's 100% automated, but it is not.
But do you think that, for example, the rollover process could be automated as well? Or there's a specific reason you do this by hand?
If you probably would spend, I'm sure if you were a really good programmer, you could probably do it for the most part. But with the software, I use TradeStation, and with easy language, which is the normal way to backtest, it would be pretty difficult. Now, TradeStation also has something called OOEL, which is object-oriented easy language, which is kind of an advanced thing. And you could probably build something around that. It's just an advanced kind of language that goes beyond easy language. So I don't do it. What I find is having to roll over is not a huge time issue. It might take a half hour a month to check and roll over and update. But the other thing too, I like it because it keeps me a little bit closer to the strategies. You never want to feel with any kind of trading strategies that you could just walk away and not look at things for a week. I mean, that's dangerous, very dangerous. And you don't want to do that. You want to be, a step away from being able to update. So even if I'm not around my computer, I can still check, if I go to one of my children, if I go to some event at their school, I can still check on my phone and make sure my strategies are synced up. Or if I go out of town, I make sure I can do that. So yeah, to answer your question, I think you probably could do a lot of it. It's just a matter of, hey, is it worth the time? And for me personally, it's not worth the time. For other people, it might be.
Having like 80 strategies running, is it very hard to control it everything by yourself? I mean, how an average trading day looks like for someone like you? Because, for someone who's new to trading, especially algo trading, for some people like this, it could look very magical almost, that you have just the computers which are trading for you on your behalf. So how an average trading day looks like?
Okay, so an average trading day for me is really not that much trading per se, where I'm entering orders, because a lot of it's automated. But the way I spend most of my trading day is developing new systems, or working on some position sizing, or doing something outside of what people would call active trading. Now, at the same time, I do at least a few times a day always make sure to go through and make sure my positions are all synced up and everything's working correctly. And I'm always here if something goes haywire, which doesn't really happen. People are always scared with algo trading that all of a sudden their program's just going to send buy orders until their account has no more margin. And I suppose that's possible if you build your algos wrong, but a lot of that comes down to just building the algos right from the beginning, and then you don't have to worry about that kind of thing. But as I'm going through the day, I'm probably, let me look. I can look at like yesterday. There were probably, I want to say maybe 15 or so orders that were placed during the day yesterday with my systems, just entries or exits. And that's probably fairly typical with the systems I'm running. So I'm not trading every day with every system. Some systems have been, they haven't taken a trade in a month. But you never know when they're going to trade it, so you just have it running, and as long as over the long run it's producing profit, that's fine that it sits on the sidelines and waits. So that's kind of, my trading day isn't really quote unquote trading, it's more system development and other things outside of placing buy and sell orders.
Okay, thank you for that. By the way, is your trading machine hosted at your house, or do you use some third-party solutions?
I personally run it out of my house, and the reason I can do that, and the reason I feel comfortable with that, is I have what I consider a super reliable internet. Of course, I have backup for that. I have backup power supplies. I have a whole house generator, all those things. But basically, my setup is pretty strong, where if my internet goes down, I want to say in the last year, maybe it's gone down less than 5 times, and it's usually a pretty short period of time. Never had an extended period. So with that kind of reliability, I feel comfortable running my systems. Now, the other part of this is, since I'm trading a longer time frame, I don't have to necessarily get in. If I miss an order by a couple minutes, if the internet goes down and comes back up, that's not going to kill me. Where, if I was doing high frequency stuff, it would be a different world. Yeah. Now, that said, I do have access to a VPS, a virtual private server, that I use on occasion, especially if I'm traveling, where it will run somewhere, and then I just remote in to check that. So I do have the ability to do that, but for the most part, I like to leave it whenever I can on my home computer, and then I have some software that just remotes in So I can do it via phone. I can do it I have a Kindle that I can just log in and see. And then if I'm traveling short distance I have a laptop and I can remote in with that, then I can actually see my screens at home. And that tends to work out for me very well.
Okay. Kevin, does it happen that although you're running like 70, 80 strategies, that the trading year may end up underwater for you? I'm asking in the context of going through the bad periods, which are inevitable in the long run, how to be disciplined in such moments and stick to with the plan.
Yeah, that's a good question, because a lot of times you can do everything right and you can have systems that are back tested and show they'll make money, but that doesn't mean the next day, week, month, year that you're going to make money. And all you can do is you got to have kind of a long-term perspective on it. I remember looking back, this was a number of years ago, but I looked at my daily trading results, and this was a year where I had pretty good profit by the end of the year, but I found out that I think it was somewhere around 60% of the days I actually lost money, which kind of amazed me that I lost money a lot more than I gained money, yet as it turned out, the winning days were just bigger and contributed and made it for a decent year. That's the toughest part about trading, is it would be really nice if I could just turn my systems on and completely walk away, and then 2 years from now come back and I'd have a reasonable expectation that I made money. No guarantees, obviously, but that's kind of what I'd expect. But the hard part about it is, no, you can't do that. You have to live through those 2 years, and you have to live through those ups and downs. And that's what makes it so hard for most people, is the path to get to that profit is what is important. And not too long ago, I think I have it on my website, I wrote an article about that might be the toughest part about trading, is actually the path while you're trading. It's not the end result. It's the path you have to take to get there. And people get tripped up by that with back testing, because you'll do a back test and you'll see this equity curve goes upward and to the right. Yeah, that looks good. It makes profit. And what most people don't look at is the path, where you have to go through extended drawdowns or extended flat periods, which psychologically make it really hard to trade. It's not a straight line. And unfortunately, just looking at an equity chart, even once you know that you have to live through those drawdowns, knowing you have to live through them, as opposed to actually living through those drawdowns, are two different things. And unfortunately, I think only real trading can prepare you for living through those drawdowns.
Okay, thank you, Kevin, for that. Very interesting. In your first book, Building Winning Algorithmic Trading Systems, you described your strategy development process. And could you please quickly describe the steps involved in this process? I mean, it seems like a very important topic for everyone willing to build a robust trading strategy.
Okay, sure. It all starts with having a goal, an objective. And, so I mentioned earlier, when I wanted to do that trading contest, my goal was 100% annual return for that 1 year of real money trading. So that could be your goal. It could be to build a strategy for soybeans. It could be a strategy to build 3 strategies for crude oil. Whatever your goal is, you want to know it up front. You also want to know what the performance is. I can't tell you how many people will email me and say, hey, can you help me trading? And I said, well, what's your goal? And oh, just to make a lot of money. That's usually the most common one. I'm like, oh, that's great. But some people actually say, well, I want 20% return a year. And I'll say, well, fine, but what kind of drawdown will you be willing to take to get that? And that's usually where a lot of people fall apart. They have no downside risk. You know, it's almost like, hey, I'll risk everything just to get 20%. Well, it's hard to create trading systems around something like that. So you need a good goal to start. Then the next thing is you got to have a trading idea, right? You got to have some basis for what your rules are going to be. You know, it could be a 5-day breakout, I'm going to buy. Or you could say 5-day breakout, I'm going to sell short. Tons of ideas out there. A lot of people think they have to come up with their own theory of the markets from scratch. No. There's a ton of things out there. You can find them. And there's a lot of code that's already written, especially for a platform like TradeStation, which has been around a long time. And that could be your starting point. And you could read about something in a magazine and combine it with something you found on the internet. There's a lot of ideas, but obviously you need ideas. And you need a lot of ideas because you're going to be testing a lot of things over time. So you have your goal, you have your idea. Then you go to testing. What most people do when they test is they take all their rules and put ranges on all the variables. And so they have, say, 1 million runs with their optimizer, and they run it up until yesterday's data because they want the most recent data in there. And then they'll go and optimize it and take the best results and go and trade it. I mean, it's awful to do that. It's curve fitting, overfitting, whatever you want to call it. So what I tell people to do is, well, just test your idea on a little piece of data. You just do what I call a preliminary test, where you don't test it on 10 years of data, you just test it on 2 years. Does it work? You know, does it give some profit? Now, that doesn't tell you the system's good, but it eliminates a lot of garbage systems. And you might say, well, wait, but maybe that was just the worst 2 years ever and all the other years are good. I agree. That is perfectly reasonable to think that, and it does happen. The one thing, though, is if you had a bad 2-year period, would that even be a system you'd want to trade? You know, think about trading a system that's in a drawdown for 2 years. Even if it makes money all the other years, that's a hard system to trade. So you got to keep that in mind too. So the preliminary testing eliminates a lot of the garbage, and so you don't waste your time testing it. Then once I have some criteria for passing that, once it gets through, I go to what is called walk forward testing. We probably don't have time to get into it today, but walk forward testing is a method of testing and optimizing where you get out of sample results. It works really well, and it tends to be I don't want to say a good predictor, but a lot of times systems in real time will act sort of like they did in backtest, walk forward backtest, as opposed to an optimized backtest where you get this great looking curve that just doesn't work in real time. So walk forward testing tends to be a good way to kind of predict what your system's going to do in the future. Obviously, you never know what's going to happen. So I run a walk forward test. Once it gets through that, I do some what's called Monte Carlo simulation, where just because an equity curve historically looked one way, boy, if you mix up the trades a little bit differently, you could get something a lot worse. And I want to know that. I want to know some of the probabilities behind a winning and losing system. So I run this Monte Carlo simulation, and again, I have some rules to say whether something's good or not. And once it makes it through all that, then I do what I call incubation, which is really you develop a system and you finish development, you're happy with it, and then you just set it aside for a number of months. And the reason you do that is because you want to see what happens in real time. You know, there's no way to cheat in real time. There's always ways to cheat back tests and that kind of thing. But to have a system and not make any changes and let it run in real time, you get some good data out of that. And what I found, especially for newer traders, is that eliminates a ton of losses from trading systems that you overfit or you curve it. You had too many parameters or not enough trades or whatever. Makes a big difference. And actually, a while back, I did a survey of my students and said, you know, how much does this incubation, has it saved you money or cost you money? And over 80% said, it's definitely saved me money. So it's a good step to use. And then once you get through that, you say, okay, it's passed all my back tests. It's performed well in a certain amount of live trading, even though you're not trading with real money. Then you look at, should you be trading at all? You know, maybe it's super highly correlated with another strategy you have, and so maybe you don't want to trade both of them. Maybe it's one where you already have 10 crude oil strategies and you don't want an 11th. And so you might decide not to trade it for a particular reason. But, you know, the option is there. And so that's what you look at in kind of the second to last step is how you're going to put this in a portfolio, how you're going to position size it relative to everything else you've got. And then, of course, the final step would be turning it on and running it live. And, you know, that's a step too, because there's definitely things you have to do to monitor a strategy. You just don't turn it on and let it go. You've got to make sure it's producing for you, or at least not losing. You know, I personally don't have a problem with strategies being break even for a long period of time. That doesn't bother me, but what bothers me is if something really starts losing money. That's what you want to avoid. So that's kind of all the steps.
It's very interesting. It seems like a pretty long way until we have something which we can put, let's say, live. But on average, how long it takes you to develop a trading strategy?
To actually run through the steps, once you kind of get used to it, it's pretty quick. I mean, that only takes a couple hours. The tough part is you usually have to go through a lot of tests to actually get to that point. So you'll go through a lot of failures. So normally what I would do is, let's say tomorrow I decide, hey, I want to make a strategy for the cotton market. And I'll say I give myself 1 week or 2 weeks. And that isn't 2 weeks full time kind of thing. It's more, I know just based on the amount of time I can spend, that 2 weeks is a reasonable time for creating a strategy. And if I don't create one in that period of time, I'll look to do something else, because, you know, usually then I start making mistakes. And my rule of thumb, and I tell this to my workshop students, is if you ever feel when you're developing a strategy that you've done a little too much, you know, you've added too many rules, too many filters, you've done too much testing, and you start to wonder, at that point, that's your warning signal that you've done too much. You've probably already gone way past what you should have done. And you never want to get to that point, because typically when you spend too much time developing one particular system, you're going to make a lot of bad mistakes and do a lot of things incorrectly.
Okay. And apart from the TradeStation, what other tools, software are you using for during the development?
During development, I also I use a walk forward software. It's called StratOpt. It's an older piece of software that was written to go with TradeStation to do walk forward analysis before TradeStation had their walk forward tool. And it's a pretty nice tool. And the other big thing I use Excel for a lot of things. And
Okay.
I know there's a lot of other specific software that can do a lot of neat things, portfolio analysis, that kind of thing. But for me, I just created most of these tools on my own because at the time it was either I didn't want to spend the money to get some of these specialized software tools, or two, I had the ability to create pretty complicated spreadsheets and macros and run all kinds of code. So it just kind of, again, it fit what I could do. And so that's kind of what I stuck with. So that's for the development side. And so obviously I'm using TradeStation to trade. And I also use NinjaTrader. And I don't use NinjaTrader for development, though. I use that primarily as an order tool. So I get signals from TradeStation. There's a way to do it where you send them to NinjaTrader, and then they go on to a brokerage. So I do trade through TradeStation brokerage, but I also use a different brokerage too. And that's always a nice thing to do, to have backups for your brokerage, because I've been through I think 3 different brokerage failures over the years. Wow. Where I eventually got most or all of my money back, but the bigger thing was the inconvenience and also not really knowing what your positions were and should you get out. But this way, if something happens to brokerage A and I know I'm short wheat, I could go into another brokerage and basically offset that so that I'm net. I don't have any exposure. And then, eventually things will kind of work itself out. So that's kind of the way I approach that, looking at multiple brokerages, because I think you want backups for just about everything you do. So I've looked at backup platforms, backup computers, power sources, internet access, pretty much everything. It's not to say there won't be something that comes up that just hits me out of the blue that I didn't plan for, but for most things, I'm pretty well covered.
Okay. Thank you for that, Kevin. You mentioned that it's very important to set a feasible performance goal. And so in your case, what is your performance goal?
I normally look for, so I look at risk-adjusted returns. And so what I like is, I'd always like my annual return to be 2 times what my maximum drawdown is. And you look at what professionals do. A lot of professionals just hope for a 1-to-1 ratio. So again, that kind of goes back to what we talked about earlier, that you want to do better than what the pros can do. So that's kind of what I aim for. Now, that being said, the last 4 full years, I think 2 of the 4 years I hit that goal. 2 of the years I didn't. But overall, I'm still fairly satisfied with the way my trading was going. You're not going to hit your goal necessarily every year, but that doesn't mean you still don't strive to get it. There's a lot of randomness and just bad luck that, sometimes you get good luck and things go a lot better than you expected. Sometimes you get bad luck and things don't work out the way you expected. And that's kind of the way I always approach the markets. I set things up that over the long run, I should be doing a certain return relative to drawdown, but in any given year, month, whatever, it might not work out that way.
Okay. You have mentioned about the incubation phase during the development process. And I have a question. What if we would reserve the last, let's say, 6 or 12 months of data, and let's call it the super out of sample data, and this would not be used during our testing or during the development. And then when the system passes all the phases you mentioned, instead of waiting, let's say, half year, we would just use this super out of sample data quickly, and then basically we could just, let's say, simulate this incubation. Do you think that this kind of approach may make sense, or it's too dangerous?
Both. It makes sense and it's too dangerous. And let me explain that. That's a great question, by the way, that you're asking. For most people, newer traders, I think it's too dangerous to do. For experienced traders, I think you could do it. And the reason why it's dangerous is what a lot of people will do is they'll leave that period out, and then they'll say, okay, I have a good system. Let me run it on my next 6 months of data. And they run it immediately. Ooh, it doesn't look good. And so then they throw the system away and forget it ever existed. And that's not the point of incubation. The point of incubation is also to grade yourself as, not only grade the system, but to grade yourself as a developer. And if you have the discipline to say, okay, the system's completed, now I'm going to look at the next 6 months, and you treat that system and you record the data, and now you treat it as if the data was in the future, then it can be useful because you're using it, but you're also monitoring your results. You're not throwing the system away. And I think that's why I don't recommend it for newer people, because they tend to think, well, it didn't work on this quote-unquote super out-of-sample period, so therefore I'm just going to throw it away. No, you should still be recording it, because you want to know how your developing is working in real time. And so you got to monitor that. So that's the one thing. The other issue with using this sort of past data that you haven't looked at is you'd be surprised how many times you might incorporate the last 6 months of market into what you're developing. I'll just give you one example. You might know right now, just looking at the markets, that a lot of markets are near record lows in volatility. Okay? And that's now in your subconscious, just because you look at you see what's going on every day. So you might go and develop a system that excludes the last 6 or 9 months, whatever, but you still might develop that system and with a volatility indicator or something that kind of takes advantage of lower volatility times. And you didn't do it intentionally. You just, came up with an idea, but it turned out maybe the reason you came up with the idea is because somewhere in the back of your mind you knew that the last 6 months have been low volatility. So then when you go and run this you incubate for that last 6 months, it might do really well because it was low volatility, which you already knew, which you subconsciously, unconsciously, whatever, put into your system in the first place. Where now you run it live and maybe now volatility takes off and your system doesn't perform. So those are the two big drawbacks to doing it. Yes, you can save a ton of time by not watching a system live for a while, but there's also, you got to realize that there are some downsides to it. So personally, what I always recommend for people just starting out doing this, let it go for 6 months. Now, nobody likes to hear that because everybody wants to trade tomorrow. Oh, I developed this today. I can't wait. But trust me, it will make you a much better system developer by doing it. It will save you money. It will make you less emotional. And in the long run, it'll be better for you. Now, maybe 5 years down the road of doing it, you might feel comfortable enough to not do the incubation phase with future data, but to do it with the past data. And that's a kind of a personal decision. But yeah, just be aware. There are drawbacks to it, but it is a great question.
Okay, that's very interesting. So I think that the good, maybe the biggest value from having this incubation is also that we can cool down our emotions. So it's, because imagine that you made this system, it was very profitable, but we had trading on paper. So we may feel like, oh my God, we could make some money. But on the other hand, we could also lose the money. So this is a period where we could probably cool down our emotions. I see at least this way.
Yeah, that's big because, as I mentioned, you go through a lot of ideas and throw away a lot of things. So when you finally find something that works, you get excited about it and you feel close to it. It's kind of weird to say, but you have this attachment to it. I created this strategy and look what it's done. And you're all excited about it and you want to start trading it. And if you do, and it starts going bad, you usually still have that emotional attachment where, oh yeah, but I spent all this time on it. It's not going to fail. I'll keep trading it. And you start cascading all these bad emotional decisions on it where if you just set it aside, in 6 months, you're not going to remember the pain that it took you to develop that system. All you're going to know is what it's done the last 6 months. Has it worked or has it not? And you're going to be a lot more focused and a lot less emotional about trading that particular system. And that can't be underestimated in my mind.
You have already mentioned about the proper diversification among many systems and many markets, timeframes. But we haven't said too much about the position sizing yet. Do you have a simple answer? Which one is, in your opinion, better? I mean, diversification versus position sizing?
It really comes back to your goals. So if you have one or two systems that are really great and that have proven themselves in real time, you might be better off just increasing position size on those systems, pushing those to the limit. Those systems are kind of rare, though, that are so good. And even if you had one, you'd be worried about it breaking and stop working. So for a lot of people, what works better is just having a basket of systems, trade different markets. And none of the systems by themselves are going to make you a millionaire. But they're all pieces, and they work together, or at least they don't work against each other. That turns out to be a better way to get more, predictable, I guess is a decent word, results, or more results that are less scattered. If you only trade a couple systems, you could have a super great year, but you could also have a super bad year. Because you're only trading two systems. It just depends how they react. Whereas if you're trading 20 systems, your chances of a super great year would mean you'd have to have maybe 15 of your systems do great. That's probably not going to happen. But at the same time, probably 15 of your systems aren't going to fail. So you have less downside possibility. So you tend to have more of an average result, which I think is a big part of it. So for me personally, I don't mind trading even one contract with a particular strategy. But if I'm trading a whole bunch of markets, or strategies for one market, I should say, it might still add up. So for example, I have I have about 10 different ES systems. So even if I traded just one contract with each, if they all happen to go long, which happens once in a while, then I'm long 10 contracts. So I still have a quite a bit of exposure in that case. And then you add in that I'm also trading some mini Russell and some mid-cap systems. You could still have quite a bit of exposure. And that's what you got to watch out for with position sizing is, if every system you have takes 10 positions and they just all add up one time, you could have a ton of risk.
All right.
So I think diversification helps you kind of reduce some of that risk. And that's the way I look at it. But so what I do with my position sizing is I normally just try to keep it something simple. You could either use a fixed fractional, or you could just say, hey, I have $100,000 in my account, or 50,000, whatever it is. So I can trade one contract for 10 systems or 20 systems, whatever it is, comfortably. And then when my account gets to this level, well, then I'll feel comfortable trading 2 and then 3, and you can just ramp it up that way.
Do you think that there is such a thing as, let's say, that once you put your strategy live, that there is an average time after which the strategy, let's say, degrades so heavily that you have to shut it down? Let's say it's just dead. Do you think that there is some average time you see that your strategies you have to shut them down?
I don't know if there's an average time, but because I've certainly had some strategies I've been trading for a number of years that it still work good. But I also have some strategies that go live, and within the first couple months, they either hit a down streak or something, and I have to turn them off. What I always assume is that all strategies will break. So the way I have things set up with the way I monitor strategies, I basically have a quitting point for each strategy. And it's usually, for me, it's drawdown based. It could be anything, but even if a strategy's been making money for a couple of years, if it hits a big enough drawdown relative to what it's had historically, I will turn the system off. So I'm always prepared for systems breaking, but I always hope they don't break. And so I just, if they don't break, I usually tend to let them go. And even if they're just kind of break even or making a little bit of money or losing a little bit, they might not necessarily be broken, but I might still trade them. But then it is as I develop new strategies, those might be the first to go, even though they're not technically broken where I've lost money with them. I might retire them and go to something else. The two of the Euro systems that were in my book, which I developed, the book came out 4 years ago, but the systems themselves I developed about 5 years ago. They were working great for a while, and then they just kind of went flat, and it coincided with a period of low volatility. But the weird thing was when volatility picked up, those systems didn't really recover. So they've kind of just been not making money, not really losing money, just sort of break even. So technically they're not broken, but at the same point, they could break, and that's when I'd turn them off completely. So yeah, I always assume that every system will break at some point. And whether it does or not, I'm prepared.
And do you ever try to fix them, or you just abandon them and you prefer to replace them with a new one?
I give them a chance to recover without me trying to fix them. The problem with trying to fix a broken one is almost guaranteed you're going to find something better, right? You're going to make a fix that's going to improve it. But that's because you're kind of using hindsight bias and saying, if I had added an RSI filter, this system would have done much better. Well, the reality is you didn't do that. So to say now that would have been a good thing to do is kind of a little fishy to me. It's not a real good thing to do. But if a strategy does return to like normal levels of performance, I will definitely consider trading it again. But it's always hard once you turn a strategy off. It's always hard to turn it back on, because for me, it's, hey, I'm talking to the strategy. You've lost me money before. Why should I trust you now? It's kind of, if you are dating and the person you're dating cheats on you, and you decide to take them back, well, they're liable to cheat again and disappoint you again. And do you really want to go through that? Same way with trading systems, where, hey, once it's failed and let you down, you may not be as anxious to let it go and turn it back on again.
Okay. And based on your experience, do you see a difference in terms of strategy longevity, depending on whether it uses, for example, small time frames, like, 5 minutes, versus long-term strategies, let's say, based on the daily bars? Do you think that there is some kind of tendency you can observe, or there's no such thing?
It's a good question. I have never noticed that. Now, it's not to say that it doesn't exist. I've never sat down and really analyzed it, but at the same time, nothing has ever jumped out at me. And a lot of times these things, just in dealing with these strategies and looking, a lot of times those things do jump out. Some little insights will become apparent. And I've never noticed something like that. Now, it doesn't mean, maybe it's just my strategies that do it, but it's certainly, for somebody who's serious about strategy development, I would think that could be one thing you would monitor, that you could look at, and you might find something there. Okay. And do you think that markets are changing so that trading as such is becoming more and more difficult craft nowadays? It certainly it doesn't get any easier. But, I don't know how much of that is people looking back at the good old days when things were easy, compared to now. Oh, everything's so much tougher now. It's the old thing. If you have kids and, they complain about being outside in the cold, and you say, well, back in my day, I used to walk in 10 feet of snow to school, and we didn't have buses, but hey, if you talk to my parents, well, we didn't even have cars then, and it was horse and buggy. Everybody seems to say in the old days, things were a lot different than now. So, there's some of that bias that's going on. But, what I will say is there's definitely a lot more. It seems like there's a lot more people involved in trading, at least from like an algo point of view. A lot of people have gotten more into back testing, where maybe 15, 20 years ago, very few people did any kind of back testing. So I think some of those systems that people found 15 or 20 years ago, other people over the years have found the same systems, and then they get traded away. So in that respect, it does make it more difficult. But, at the same time, everybody's has access to better and better tools for doing stuff, so that in that respect, it should make finding things a little bit easier. So, for me personally, I think it's tough. It's always been tough, and it always will be tough. Okay. Thank you, Kevin, for that. So we are almost at the end of our interview, but I have just one last question, which is pretty long, or maybe the answer will be short. We have described the strategy development procedure, and it turns out that it may be pretty complex way to build something which is robust. And because of that, we are also looking for a portfolio of multiple strategies. We don't want to rely on a single strategy. But I would like to ask you about a bit different philosophy, namely the long-term trend following. I spoke recently on my podcast with Tom Basso. He was also working closely with Longterm, and he was also featured, for example, in Jack Schwager's Market Wizard book. And my understanding of his approach is that
he is not putting too much effort into finding a perfect entry or exit methods. He's looking for a very long-term trends. And the crucial rule lies in the proper money management and portfolio diversification. So basically, he's just using a single system, but on a very big portfolio of different markets. And what do you think about such approach? I mean, rather than constantly, let's say, fighting with the market, trying to find new systems and to replace them with a newer one, we have a trend following system which works hopefully for years, just a single system on a very broad market. Do you think that from your point of view it's even feasible?
Yeah, I mean, I definitely think it's feasible. And on one hand, that is appealing because, yeah, you're not spending as much time looking for these individual systems. You just go with the long-term trends. One of the things that people always bring up, well, hey, if a lot of people do it, the trends won't be as long. And, you know, depending on how you get in and out of trends, you'll get in too late, you'll exit too early, and there won't be enough benefit for you. So you got to watch out for that. The other issue with a lot of trends, a lot of people like to look at them as like seasonal type trends, you know, say like grains might go up during the summer, especially if there's a drought and that kind of thing. And what we've seen in the past, I don't know, 3 to 5 years probably is seasonal patterns that were historically pretty reasonable on a seasonal basis haven't been working. So things have kind of been upside down. So when you combine that with like long-term trend following, the thing you got to be able to do with long-term trend following is to be able to stick to it. And that's where I think it makes it really tough for people just headed through those drawdowns. You know, yeah, you could benefit by holding something for 2 or 3 years. The question is, would you be able to last that long with its ups and downs? You know, talking about stocks, which we really haven't talked about, but I saw somewhere it was, I don't remember the exact figure, so I apologize for that, but basically if you had invested in Apple stock in 1995, you'd have so much more money today. That would be a long-term trend follower, right? You pick the stock and you say, I'm just going to go with it. But the problem is, you know, knowing what's enough? When do you get out? How long do you ride it? And 2, would you have been able to endure those times like with Apple where, you know, there were a lot of people forget there was a time where Apple was pretty much on death's door, that it might have just disappeared. I remember thinking that, hey, Apple might not be around. And I think that was around the time right before they came out with the iPod, and that kind of transformed what they were doing. So that's the issue with any kind of like long-term trend following is you've got to really be able to stick with it. And, you know, but if you have that kind of philosophy, if you think today, hey, gold's at a reasonable price, I think in 10 years gold is going to be worth a lot more, you know, that might be a very sensible approach for you. But you know, you wouldn't be able to look at the day-to-day fluctuations because that would drive you crazy. So, you know, what Tom is saying is definitely there's definitely validity to it. It's having the intestinal fortitude, for lack of a better word, to stick to it. And I think that's where it gets tricky for people. They have trouble sticking to those kind of approaches.
Okay, so the conclusion could be that from the psychological point of view, at least you personally, you have more trust in the short-term trading systems, and therefore you just went this way. But it really depends on our personality, which way we go. And from what you were saying, the long-term trend following may have sense, but we have to be really a person which really wants to go this way?
Right. And so I do my active trading, which is like the futures markets, with more of these short-term systems, days to weeks. I have a few that last a couple months, but all my long-term stuff is usually like retirement accounts, and that's more stock-based because I am what would be considered a long-term trend follower in stocks. So I just put it in either index funds or ETFs, that kind of thing, and just let it go. And I don't look at the fluctuations. Okay. Because I'm thinking in the long term, that's going to be a good way to go. So you're right. But you definitely want it to stay with your philosophy of being something that fits what you want.
Okay. Thank you very much, Kevin, for all your answers. It seems that we have covered all the questions. Do you maybe have anything you would like to mention before we will finish today's podcast? Really,
maybe in the beginning, I was kind of a little bit pessimistic and, telling people how trading is tough. But I always like telling people that rather than just showing the glory of the upside. I mean, yeah, it's great getting returns that are good, but unfortunately, that's where most people focus, and that's where I think it's dangerous. What I'd recommend to people just getting into trading is don't focus on the upside, even though that's the nice way to think about it. Focus more on limiting your downside. Worry more about getting wiped out and worry about drawdowns, because that's where people get into trouble when they don't worry about those things. And if you do it right, the profits more or less take care of themselves. By no means are they guaranteed, but if you focus on the risk control, I think you're more likely to succeed in the long run. So that's probably the biggest thing I'd mention.
Okay, thank you, Kevin, for that. If someone would like to learn more about you or to get in touch with you, what's the best way?
They can visit my website, kjtradingsystems.com. I also have some contact boxes on there, or you can just send me an email, Davey, so it's KDAVEY at kjtradingsystems.com. Feel free to ask questions. I answer questions from people all the time, especially once my book came out. I got flooded with people just asking random questions and stuff. But I'm always willing to talk to people. I don't ignore people. And take a look at my website. You'll see I have a ton of free stuff out there. I usually do about one free webinar a month. I've done a bunch of podcasts. Now I'll have your podcast to add to the list. A lot of stuff where you can really learn a lot about what I do, how I do it, and some of the things I've learned along the way.
Okay, I will put all these details, the contact details, for example, on my website. So if everyone is looking to contact you, there will find the details. Kevin, thank you very much for your time. It was a pretty long discussion, but I believe there's a lot of value for everyone. So I'm very, very happy that you agreed to spend your time with us here and share your knowledge, experience. So I appreciate it very much. It was a big honor to me. Thank you very much.
Yeah, well, thanks for having me. And again, I've seen some of the people you've interviewed, and I'm sure you're going to have some other great people in the future you're interviewing, and to be included in that group it's really an honor for me to even be in the same sentence as somebody like Van Tharp or Tom Basso or Andrea Unger. I mean, I get a big kick out of that, so that's really cool.
Thank you very much. Have a good day.
All right, thanks.
Bye-bye. I hope you liked the show. As you could notice, there's an endless number of trading approaches. However, once a given approach proves to be valid, the key is to stick with it. I encourage you to visit my website at systemtrader.show/006, where you can find more materials related to this episode. Also, you may put there your comments or questions related to this episode. Now, I would like to thank you for being with me. I wish you all the best, happy trading, and goodbye.